Good morning, ladies and gentlemen. Good morning, ladies and gentlemen. Welcome once more to phase 2 of DTB's personal financial literacy training. Thank you so much for joining in. Karibuni sana. This is our second personal financial literacy training in the year. We had our first one in the month of May, and thereafter we had one on SMEs, training for SMEs that happened in the months of July and August. And now we would like to get into phase 2 of personal financial literacy. If you remember, and we will dive into a recap later, we had a bit of the basics that we covered, and this time we thought to just dive a little deeper based on the feedback that we continue to receive from all of you about how these sessions have impacted you. We've been gathering feedback ever since that first training, and it's really encouraging to see some of the milestones that participants have made. So welcome, karibuni sana. We see you on the chat. As always, we'd love to know where you're joining from, why you've come again. If this is your, if this is your second time joining in, what brings you back? What have you changed? And if this is your first time, what you're looking forward to as we roll out phase 2 of the personal financial literacy training. So welcome, ladies and gentlemen. We see you on the chat. We see also familiar names, and then we're very excited for phase 2. So we will have today's session on debt management. So we will have we have really great things in store for you, but we will begin with debt management. I think you can also see a familiar face, Elizabeth, on the chat. So it's in collaboration with Zurich Consulting once again. And, you know, just as you're saying good morning, let us know what you're looking forward to on today's session, but also the ones that are going to follow. So karibuni sana. I'll just give a few minutes for everyone to join in as we read from you on what you are looking forward to. We have come in, this is your first time, karibu sana. We hope that you will gain so much in these trainings. So welcome, ladies and gentlemen. Okay, even as we wait, I will just invite Elizabeth to say hello before we get into the training. Karibu, Elizabeth.
Thank you so much, Manchui, for having us this session. It is always a pleasure when we have to come and learn from each other. Remember, yes, we are facilitating the sessions, but we are learning from each other because life is a continuous learning. So thank you again for allowing us to be in the phase 2 of the personal financial training. I think the first one was really, really impactful. We did 4 sessions. We went through understanding our financial position, because remember, we cannot change that if we do not know. So it is very important that we understand where we stand so that we can be able to work on that. We explored the various financial pillars. That is, how do you increase your income? How do you invest? And then more importantly, what will you be remembered for? Especially right now when we're thinking about honoring we're just thinking about legacy. What is it that people will remember about you? So legacy is a key thing. And when it comes to finances, you must think, how will you leave your house in order? And then you also looked about budgeting and cash flows, because yes, most of us, especially in business, money is money. So money comes in from one side, maybe it's supposed to be go to something else, but how do we create balances and boundaries between those two? And then finally, we looked at how do we make sure that our money is working for us. At that particular point, we actually had a collaboration with the custody team that took us through how we can invest in the various asset classes. This particular session, this particular series, we shall also be looking at the various asset classes and how you can actually utilize your money to do that. So today, it is going to be all about conversations about debt and how we can actually use other people's money to make money and become better. So since we last had each other, or the last time we were here, we discussed about how do you keep yourself accountable. We have actually improved the Zurich, and now we have a dashboard that you can actually use to understand where you are, you can do all your investments and track all the way to legacy. So one of the things that we shall be doing during this conversation is actually just give you a link where you can be able to fill your details, and we will be able to reach out to you so that we can help you make the right investment decision and track them for yourself, because you're the one in charge of your money. So thank you so much, Vanturi. I don't know whether we start or I think I was told to say hi, and I've really, really said hi.
Thank you. Thank you, Elizabeth. Always great to hear from you. So I think we can begin. I will just give a brief introduction of Brian, and then we can dive into the good stuff. And as always, for our participants, feel free to engage on the chat, ask questions, make your comments. And last time we also saw how we can also learn from each other. So feel free to share also your own nuggets of wisdom in your own debt management journey and generally in your own personal financial management journey. The aim is that we create a community that enables everyone to thrive when it comes to their personal financial management. So Brian Gitia is a financial wellness and investment expert with a deep commitment to empowering individuals, businesses, and institutions to make smarter financial decisions. With a background in housing finance, capital markets, and real estate investments, he blends technical expertise with a people-centered approach to financial education and strategy. He has led fundraising efforts, built robust financial models, and advised on investment strategies for multi-sectoral projects valued in the hundreds of millions. Beyond transaction, Brian is passionate about demystifying finance, breaking down complex financial concepts into practical tools that support everyday financial wellness, long-term planning, and wealth creation. So once more, as you can see, you're in very good hands. Let us take our notebooks and pens and let's get ready to learn. So without much further ado, I'd like to welcome Brian and also mention that for sign language interpretation, we have Lillian and Victor. We'll also communicate the same again on chat. Karibu sana, Brian.
Thank you so much. Thank you for this opportunity. And I'm happy to be here, happy to see all of us bright and ready to learn today. So today, I'll be taking you through the debt management aspect of this training. So we've covered a lot in the first session. As Elizabeth has recapped, there's a lot that we got to learn in the first session. So now in this second phase, we're going to start with debt management, getting to understand how are we able to use debt to benefit ourselves, to build ourselves, and not as a stress, something that is stressing us. So how we'll start by that is getting to understand the various kind of debts, how they affect our lives, and how to properly work with this debt. So as we start, I'll start with something that Elizabeth has mentioned, that it's first of all very important to understand your current position, even before you start moving ahead. Before you head somewhere where you're heading, you have to know where you're starting from. You have to know your starting point. And so with that, you can see on your screen, I've put a very short quiz for us to get to interact and get mentally to put ourselves where we are when it comes to our finances and when it comes to our debt. So I'll request you to feel free to type in the chat box A, B, C, D, E, or F based on where you think you stand. So the question is, if debt were a person, how would you describe your current relationship with them? So if you could assume debt being a person, how would you position yourself in your current relationship with them? Is it that A, they show up uninvited and never leave? Or is it B, it's complicated, you're on a repayment plan, but it's still a bit complex? Or is it C, sneak up on you and you're not looking, you just find yourself getting into debt without having anticipated or planning for that debt? It just happens. Maybe you're caught in an emergency, something happens to you. Or is it D, where we are working through it one step at a time? So you know how much debt you have, but you're just slowly working through it and getting to position yourself one step at a time. Or is it E, where it keeps trying to call you, but you're blocking their number? Maybe now here you have debt collectors trying to reach out to you or trying to talk to you regarding your debt, but you're avoiding them or trying to block their number. Maybe you could be in that position. Or F, where you've made peace and you've got a structured plan. So please feel free to type in the chat box and also now see where your fellow colleagues are when it comes to their debt position. So when you start with that, it helps us put ourselves into context as to where we are starting from. So I'll go into a brief narrative of the Kenya loan story. The debt situation in Kenya is not a unique situation. individuals are, many
Brian,
individuals are facing a debt burden.
Brian,
Yes, yes,
I want
please.
to stop you, Kidogo. I think you need to
Sure,
acknowledge
sure.
the number of points that are coming in there. People and what
Sure,
they're
sure,
saying they're
please.
facing position. Maybe you can just check on the
Yes.
comments. You can go back
So
one step.
so I am seeing there's a number of Bs that are coming in where people are saying it's complicated. We are on a repayment plan. I am seeing some C's coming in. They sneak up on me when I'm not looking. So where you're not planned for it, we end up getting into debt. I'm seeing A, then F. They show up uninvited and never leave. But we've made peace, and I've got a plan in in place. Then you're also seeing there's E, keep texting me, but I'm blocking their number. Maybe it's now time to learn how we can unblock them and start dealing with it and getting into a point where you've made peace and you've got a plan. Then you're also seeing D, we are working through it one step at a time. So you can see that all of us are falling in very diverse places when it comes to our debt. I'm seeing someone says, poor me, A, and then E. They show up uninvited and never leave, but keep
Yeah.
texting and block their number. So this shows us that many of us are in different places when it comes to our debt and handling our debt. So it shows us that you're not alone. There's many experiences, but we all want to get into a place where we have made peace with it and we've got a plan. So throughout today's training, we'll go step by step as to how you will get from point A or from point C, where debts are showing up uninvited or they're sneaking up on you and you're not looking, until a point where you've made peace, you've got a plan, or you get to the point where you're not even requiring to use debt unless now you only use debt when you're using it for expansion and for growth. So we'll also look at some of the ways in which you can use debt for good. So thank you for that. Thank you for participating. So we'll go to the next one where we get to understand the context of debt in the Kenyan situation. So we start with the World Bank estimates on our debt, saying that household debt in Kenya is reaching up to 25 to 30% of GDP. This shows that a huge chunk of the economy is fueled by debt, and most of it is household debt. Then we are seeing when it comes to mobile money and borrowing, 40% of mobile loan users borrow monthly. So be it on your M-Shwari, be it on your Tala, be it on any other mobile money platforms, we're seeing around 40% of these users borrowing on a monthly basis. And then 30% of the borrowers, or these people who are borrowing, they end up defaulting. So you're seeing a huge chance. So that for every 3 people borrowing, there's a huge chance that one of them is going to default on that loan. So that shows how big the gap is when it comes to debt management and proper debt management. Then looking at personal loans, we're seeing around 1.2 trillion Kenya shillings owed to banks through these personal loans. That's a huge chunk of the economy that's attributed to personal loans. Then you're also looking at one of the mobile loans, the Fuliza loans, seeing over 350 billion in active Fuliza loans, which has even now grown exponentially since that last reporting time. So you can see there's a huge debt burden for a lot of people locally, most of it being going to personal debt or and being accessed through mobile money, given that it's more convenient, it's very easily accessible. You don't have to explain to anyone, you don't have to provide collateral, you can easily access it. But now, on the other hand, given that these loans are considered more risky by the people who are lending, they will charge you a higher rate. And now this higher rate ends up now getting you into what we call a debt cycle, which we'll look at in our subsequent slides. So you can see that puts into very important context the kind of debt that Kenyans are carrying and the kind of implications that these have on household incomes and on personal incomes and also on personal finances. So let's get to understand. This is also another metric that some other statistics that show the debt situation in Kenya, where we're seeing over 28% of Kenyans are struggling with repayment issues. We have 53% of Kenyans self-reporting that they were overwhelmed by debt. And then we've also mentioned now the default rate on digital loans, which has kept increasing over time. So we'll start with looking at an example of a case study of a lady called Janet. So Janet, take her to be an example of yourself or someone you know who is probably facing a similar situation. I'm sure most of us know someone who is in a similar situation, and we'll get to break down the story and get to understand how you get into such a situation and how you're able to get yourself out of such a situation. So you have Janet, who is a 37-year-old that's struggling with bad debts despite being employed with. She's employed and she has 2 children. So she's 37 years, as I said. She's employed as an administrative officer, and then she nets a monthly salary of 65,000, and she has two children, aged 6 and 9. So how she started getting into debt, how she went into debt is because she was borrowing occasionally for comfort and convenience, despite having a stable job and regular income. So the lack of proper planning and the lack of proper preparation ended up in her having to borrow either for comfort or convenience, and now that led her into the debt spiral. So the spending pattern, typical spending pattern is mobile loans for non-essentials such as clothes, going out or ordering in, and then buying the latest gadgets or upgrading the gadgets, buying some home items on credit, some of which are necessary or not really necessary to get at that point. Perhaps you could have saved up for those. And then there's no savings plan. Just
Sorry, Brent.
the day, everything she spent, everything we utilize.
I think we lost you a bit, Elizabeth. Maybe you can confirm.
Brian, you're
You can hear
getting
me?
lost. You're getting lost. Yes, yes,
You can hear me now. Sorry for that.
we can hear you now.
Sorry, at
Yeah.
which point did you lose me?
I think it was you can continue from the spending pattern.
Okay, got it. So yeah, we have seen Janet's spending patterns, majority of it going. She's getting a lot of mobile loans to finance typical the consumption expenditure, such as buying clothes, buying some home items, some of which are not very necessary, and also now running without an emergency plan, whereby she's spending whatever everything she gets is spent. There's no savings that she's putting aside at the end of the month, and there's no emergency buffer. And what now ends up in such a scenario whereby you have no emergency buffer, so even the smallest cost ends up now becoming a debt issue. So for example, let's say your phone breaks down. It's a small cost in fixing it. Maybe it would cost you 2,000 shillings or 1,000 shillings. But let's say that time it's maybe the 24th. You've not been paid yet, or you've not received money from your clients yet. So at that point, you don't have any money. You end up having to go into your mobile money loan to take out a loan so that you can be able to finance that purchase of the phone. And now that starts a debt cycle whereby you keep going further and further into debt to be able to finance your typical expenditure, because you're not able to save up and put up an emergency fund for yourself. So she ends up in the trap because now she's borrowing to cover loan repayments. So if let's say a mobile loan falls due on a date before she's paid, she has to borrow from another one so that she's able to pay for this one, so that she's not blacklisted. And it becomes, she's always juggling a number of debts to try to stay afloat. So even now, that not having a savings plan, she ended up now depending on digital loans to survive between paydays. And then by the end of the month, every month, she ends up having a loan burden of around 18,000. So out of a income of 65,000, a huge burden of that of 18,000 is going to make payments towards debt. It's not something that she can use to build herself. It's not like a saving where she'll be able to utilize to improve her financial situation, but it's just a debt that is continuing, growing, and eating into her income. So at the end of this, what happens? She's surrounded by items with no long-term value. We've seen she buys a lot of gadgets, home improvements, things that are not quite necessary and that don't appreciate in value. Rather, they depreciate. So at the end of the period, she's surrounded by items with no long-term value. She's under constant stress and financial stagnation because now she's unable to invest since she has no savings. She's unable to even put money aside to tap into any opportunities that come her way because she has nothing that she can tap into. All of her money is going into servicing her debt, and the little that goes into expenditure has to be supplemented by more debt, building that debt cycle. So that even affects the way she works because she's under constant stress and she's financially stagnant. Then no progress despite full-time employment. So we've seen whereby she's unable to even save and get any income that can, any investments, like any savings that can build her investments. So she's not even able to progress herself. She's not able to improve her financial situations. She stays at the same position despite having been in full-time employment. So you can see how simple debt can grow into something so big, and it ends up affecting your long-term financial situation just because of small decisions that we make, or because we are not able to make proper decisions when it comes to choosing debt and taking out debt. So we've talked about how debt decisions affect your financial situation. So we can start by looking at a few steps that you can take when you're making a decision when it comes to debt. So before I decide on whether a debt is worth taking or not, what are some of the things that I should consider? So the first thing, you need to start by clarifying the purpose. So you have to know what this debt I am taking for. What is it going to fund? Is it going to fund something that is going to generate a bigger return in future? Or is it just going to fund a consumption expenditure that does not yield me anything? Or buying something that is actually going to depreciate and is going to end up costing me more in the long term? So determine if the loan is for growth or for consumption. Then you assess your current financial position. So where you are currently, are you able to afford this debt? In as much as you have that limit and you can be given that limit, is it something that is within your affordability? Are you able to service those debt payments without putting unnecessary burden on yourself? Do you have are you still able to continue making your regular savings for your emergencies and for your other long-term savings perhaps? So you have to evaluate yourself and see how much am I able to pay in all this, am I able to pay for the cost of this debt, and is this debt sustainable for me? Then after you look at that, you now also look at other alternatives. Perhaps this mobile loan that you're taking is not the best alternative that you can get. That loan is too high for you because the rate might even translate to something, let's say 40 or 50% in a year on a per annum basis. Could there possibly be somewhere else where you're able to get a debt for a more reasonable amount that you're not even able to get a payment plan that works for you and does not lead you into that debt trap that we saw happening to Janet? Then understand the loan options. So once you've gotten to understand the alternatives, get to know what each option entails. What are the payment requirements? How long will you be paying that debt for? What is your interest that you're bearing on that debt? And by when should you anticipate to have finished paying off that debt? And can you comfortably do that? Get to understand it all, including the hidden fees. Because at times you might be lied to by when someone is trying to get a debt. For example, if it's a mobile loan, they tell you, oh, we'll only charge you a 5% interest, but they haven't put it in fine print that the 5% that you're being charged is on a per monthly basis. So when you annualize it, it comes to a 60% rate. Or they say there's an approval deduction first, or an approval charge that is a huge amount that even now makes the rest of the debt, the effective interest rate be much higher. So you have to know those options and be very sure of how much debt you're taking on. And then also the next step after that is evaluate your return on loan funded investment. So we have said the best use of debt is to use debt for something that is going to grow you. So if something that's going to grow, at what rate is it growing? Is it going to be giving you a better return than the debt you're getting? So for example, going back to that case of a mobile loan, I take a mobile loan perhaps to invest in make a business, and I know there's a transaction that I will do that will give me a return of, let's say, 30% or a 20% return. But the loan I'm getting is at 35% or even up to 50% if it's a mobile loan. So you can say,
Brian, we're losing you again.
sorry, is it better now? Sorry, someone tried to call
Yes.
me. I was hotspotting myself. Apologies for that. So yes, as I was saying, when you're evaluating your return, when you're evaluating your debt, whether a debt is worth taking, consider the kind of return that you're going to get on that. So if my business is only going to give me a 25% return or a 30% return, then it makes no sense for me to take a debt that's going to be 50% in total return, because at the end of the day, all my money will have gone to finance this person who's giving me the debt, as opposed to building myself and setting myself up. So that's very important to consider. That look at the kind of return, whatever you're investing it, be it for your own education or to improve your or to get yourself a promotion, wherever you're taking that debt to improve yourself for, or even to invest in something else, ensure that the kind of return that you're going to get is going to be sustainable to pay back that debt. Then use a loan calculator to estimate the total repayment. So as Elizabeth has mentioned, we actually have at Associate Consulting, we have the Prosperity Dashboard, which has a debt management tool that can help make this easier for you, whereby you're able to do a calculation of the kind of loans that you have, where you're able to list out all your loans and try see, does this make sense for me? Am I able to manage those repayments in addition to the debts that I already have, or in addition to other debts that I anticipate coming through my way? So that helps you see your total repayment and see whether you're in a comfortable position to pay those debts. Then the other thing is you also have to have a proper repayment plan that aligns with the payments that you're going to be making. So for example, if I'm investing in a business that's going to generate me income on a quarterly basis, perhaps, and the kind of repayments I'm making are on a monthly basis, that alignment might be mismatched, whereby I find that a debt repayment, my debt is due to be repaid, but I don't have enough money to repay that debt. So I have to tap into my other incomes to be able to pay that debt. So it's important to map out that repayment plan very clearly, even before you take up the debt, so that you're very comfortable, even when you're taking on the debt, to ensure that you're able to pay it on time and without unnecessary burden to yourself. Then you also have to check the emotional readiness for that debt. Because in as much as you might be able to afford the debt, the repayment plan works for you, maybe it's something that will have you overworking yourself so that you're able to make that payment. And maybe that overworking yourself is not going to be sustainable for you. You're going to be burnt out just so that you can survive on a certain debt. So also remember the emotional cost of taking a debt upon yourself. For example, if you go back to Janet's case, whereby she took a debt to finance her expenditure. So in as much as she's comfortable, she's added a few things to her house, the emotional burden of knowing that out of her income, almost a third of it is going to repayment of debts without building herself. She's not invested in long-term debt that is building assets for her or that is helping her financial situation in the future. Is just on consumption. So that's going to take a huge emotional toll that's unnecessary at that point in her financial journey. So by considering these steps, you're able to now make informed loan decisions, whereby you're not just loaning out, you're not just taking a loan because you have access to that money, but you're taking a loan because it aligns with your financial goals, it aligns with your financial strategy, and it makes sense. And the kind of return that it is giving you is sustainable to pay itself back and get you something on top. So those are some of the things that we should consider when you're getting into loan agreements. So let's get to understand. We've talked about what you should consider when getting into debt, but let's get to understand also what makes people get into debt. What are some of these factors that lead people into getting into debt? So we've mentioned the first one, which is very tied to Janet's case, whereby it's emergency without savings, whereby you have no savings for yourself. So any small eventuality can end up with you having to tap into an emergency to be able to stay afloat. And it doesn't have to be a huge emergency. We've seen something like the phone issue, whereby I said your phone breaks down, you don't have savings where you can be able to fix it, so you end up having to take out a loan to fix that phone. By the time the loan is due to be repaid, you don't have enough money, so you have to take out another loan to keep doing that. So it can easily grow and lead you into a bad financial situation. Then the other part is lack of financial literacy. So whereby you're not able to get to properly understand what good versus bad debt is. What is debt that is going to build you versus debt that is going to ruin your financial situation? And what are these long-term impacts of some of the debts that we can take on board? As opposed to just looking at it's debt, I can access it and I can repay it. There's some other impacts that you're not considering. Perhaps this debt is stopping you from savings that could have built an investment for you that could have improved your financial situation. But by you taking that debt and committing this amount of money to repaying the debt, you're stuck in that situation. So it's very important for us to consider that. Then the other thing is easy access to high interest credit. We've seen this happen a lot with the proliferation of mobile phones and mobile loans these days, whereby anyone is able to access a loan. You don't have to walk into a bank and provide collateral or have to give a business plan or have to give a financial plan to show how you'll be able to repay it. Here you can access, and they even say instantly. So within 2 minutes, you already have the money in your account. It doesn't have to see, they don't have to see whether you're wise enough to take that loan or you're in a position where you should be taking that loan, maybe even outside having fun with friends, and you decide, let me just take 2,000, I'll pay it back. But things like that keep adding up. But now that easy access enables people to now keep tapping into debt and getting into worse debt situations. Then there's also the issue of overconfidence or misuse of credit. So sometimes you say, given that I know this client is going to pay me this invoice I sent them, I can just take out a loan and start spending that money. And then the client perhaps doesn't pay on that deadline that you had agreed upon. So now you have to take another debt to refinance that debt, and you end up getting into such a situation. Even something like salary delays, whereby let's say you're a salaried employee and you have a frequent date when you get paid on, something happens, the salary delays, but you have all your mobile loans lined up on that date, or the repayment dates are lined up on that date. So you end up now having to get into worse situations, getting desperate and taking loans from other situations, which you've not even do before. But now, given that overconfidence or the misuse of credit that you did, you end up now ruining your financial situation because of something that could have been avoided. Then there's also the aspect of poor budgeting and no spending plan. So we've seen, even in the case of Janet, she had that situation whereby she's not able to manage her income properly, whereby every coin that is coming in is going out. So whenever she needs to spend on something, and given that she has easy access to debt, she ends up taking this debt so that she can be able to pay back. So that is one of the huge reasons why people find themselves in debt, because you start like that without a proper budgeting plan, and it ends up now growing into a huge debt trap. Then there's also another huge factor that people face, where it's lifestyle pressure and social comparison. You feel pressured because all my colleagues have a car. I can't be the only one who is coming to the office with a matatu. Or all the people who around me who own businesses, they drive their own cars. I can't be a business owner, and I'm also not driving a car. So I'm pressured to buy a car, take out a debt that perhaps I cannot afford to finance, and is not going to build me, just so that I can be able to fit in with everyone else. There's even family expectations. Someone says, because you work in such and such a place, you should be able to send this much money home every month. So you end up struggling and having to take out loans so that you can support your family, or buy them whatever they would like, or even pay for their education, things like that. So those family expectations and societal pressure ends up now leading people further and further into debt. And then there's also the aspect of emotional spending, whereby you are spending whenever you're upset, you're spending whenever you're stressed, or you're spending when you're influenced by others, just to just to just to keep yourself in a certain state of emotions, just to make yourself comfortable, to make yourself feel better. And now this ends up leading you into further debt. So, for example, you feel bad that every time my friends invite me, I can't show up. So let me just show up at least this time, so that I cannot seem like a bad friend. But for you to show up, you had to take out an M-Shwari loan so that you can pay for your transport to get there, or buy lunch when you're having lunch with your friends. Things like that can now affect you. And also now spending when I've had a bad day, let me go treat myself to feel better. But I've had such a good day, let me call everyone to go celebrate. So things like that emotional spending can end up with you getting further and further into bad debt. So let us look at some of the times when one can borrow to pay a loan, because sometimes we always talk about having good debt, whereby it's debt that you're using to buy an asset, or to invest in an asset that's going to generate revenue. But you'll also find there are times some of us get into debt, but we need to borrow to pay that loan. But now, before you get into that situation, you have to get to understand what are some of those instances, so that you're not just getting yourself further and further into a debt cycle, but you're actually using debt to help you get out of your debt situation. So the first instance is when you're taking out debt to replace expensive debt. Let's say you had that mobile loan that's charging an equivalent of 60% interest, but you're able to access a loan from your bank, which will charge you, let's say, even up to 18 or 20%, including the other charges. So that makes sense for you to get out that loan from a bank, which will give you much more preferable payment terms, will allow you to pay over perhaps a longer period of time with a lower interest rate. So you use that to replace that expensive debt, whereby you get lower interest rates and you have manageable payment periods. And then you can also do it to consolidate the debts in a similar scenario. Let's say you have a debt, a Fuliza debt, an M-Shwari debt, a Tala branch, all those. You have all these debts combined, and each is, let's say, 2,000, 3,000, 4,000. They're all adding up. You can get someone to consolidate these debts, and now you're left dealing with one lender. And why this works is because, first of all, it will help you manage the repayment periods. As opposed to having 4 different repayment periods in a month, you can now agree with your financier that you have, they buy off your debt and you're just paying them one in one installment. You can even make it easier whereby it's, for example, it's a check-off system where you don't even have to be involved. It's done through standing order where everything is paid off. So it's very essential too. That's one of the way where taking out a loan could help you. You could use a loan to take out another loan. Then you can borrow a loan to take out to pay for, you can take out a loan to pay for another if you want to get a clear repayment plan. So we've mentioned a bit on the repayment plan, whereby by you getting another financier who can give you a more clear repayment plan, that helps you plan yourself better. It helps you plan your finances better, because this one is more, it's more fixed, it's more long term, as opposed to the short term ones where the repayment plans are not very clear. Perhaps you take a loan, within 1 week, they've already started calling you to start repaying, be it was supposed to be, let's say, a 1 month loan or an extended period of a loan. So you can take out a loan so that you can get one that has a more clear repayment plan that is aligned with your needs. And then in some instances, you can use it to get out of yourself, to get yourself out of a financial crisis. Perhaps you're in a situation whereby you have all these debts piled up and you have nothing else to do. You're not able to consistently manage them, or if anything, or you're about to either lose something or lose some of your assets. So you might now take out a loan so that you're able to clear that, and then you're left now managing. You're left now dealing with a more manageable loan. But this one should only be used when it's a rescue, and it's not a pattern. It's not that every time you're going to be using that. It should only be a last resort option for you. And for this, we just summarize by saying, to avoid getting into all these situations, do not borrow to pay a loan unless it is very essential and you have gone through all these criteria and you have ensured that it is in the best interest of your finances to take out this loan, just to ensure that you don't get to a worse situation, or you improve your situation. So avoid taking out loans for consumption, to maintain an affordable lifestyles, or using expensive debt just to stay afloat, while you could restructure the debt and use more sustainable debt methods that ensure you don't ruin your financial future. So we've looked at this, some of the reasons why people get into bad debt. We've mentioned some of those factors, so I won't get much into them, but I'd also recommend, please feel free to type in the chat box. If you see any of these reasons that relate to you, perhaps you've gotten yourself into debt and you've seen a reason that maybe you can relate to, please feel free to type it in the chat box. Then you can also be able to see that you're not alone in case you got into a scenario because you didn't plan yourself properly, you didn't budget yourself properly. Perhaps you'll be able to see that it's not just you who is going through the same. There's also some of us who are facing the same challenges, and you can be able to learn from each other and support each other. So please feel free to type that in your chat box. So when we talked about our case study of Janet, we talked about how she got into a debt burden. So how are we able to flag and say that my debt at the point where I am in a huge debt burden that it's not sustainable for me? So this is what are the kind of warning flags that we should be looking out for to identify whether you are in a debt burden or not? And you can try to tie it back to Janet's scenario and see where some of the warning signs that she had exhibited. So the first thing we'll start with, you remember in our first, when you asked the question of the relationship with debt, some people picked point E, whereby they said, I'm blocking their calls, we do not talk. So you have the situation of avoiding communication, avoiding, ignoring bills or creditor calls. You find yourself in a situation whereby you're not able to even respond to the calls that you're getting from your debtor. You're not able to and even take calls from unknown numbers because you're scared it might be a creditor calling you. So that's a huge sign that you are not in a proper debt situation, and you should try fix that. Then stress and anxiety. If you are experiencing stress from debt, that shows you that it should be a warning sign that perhaps where you are is not the best situation you should be in, and you should try start reworking your way out of that. We would mention in the previous slide the impact of debt on your emotions, whereby if it's stressing you out, it doesn't mean that you should, if you can afford a loan, you should take it. If it stresses you out, it's not worth that loan. You should consider getting other options for that loan, or figuring out a way where you can get yourself out of that situation. Perhaps consider consolidation of your debt. Perhaps consider seeking somewhere where you can, a debt management tool where you can be able to now work out your debts and see how am I going to be able to get myself out of debt through the various methods that we'll also now cover in this session. Then maxed out credits, where you've reached out your credit, you've reached out your Fuliza limit, your Mshwari limit, you've reached them, all of them, or you're consistently always near the limit. That should be a huge warning sign that you're in a debt burden because you're not able to consistently make your payments while still keeping some savings aside for emergencies. Leading to our next point of no emergency savings, whereby if you find yourself in a situation whereby you can't save because you're always financing your debt, that's a huge red flag because, as we said, this lack of savings is what will not even lead you further into a debt trap. So if I don't ever get my savings in place, I will always be relying on debt. So even if I pay this debt, I will end up sinking into another one. So you always need to have space for emergency savings. So even as you're making your debt repayments, you should be able to save up on your side for your emergency savings. Then there's missed payments. Whenever you're falling behind on payments or not making a payment on time, that should be a huge warning sign that the debt that you have is unsustainable and you should be able to now start reworking it and figuring out a way to get out of it. Then there's also the issue of postponing life decisions. If you find yourself postponing life decisions just because you are in too much debt, perhaps you can't go back to school to further education because you're already in too much debt, or you can't start now saving up for your retirement because you're in huge debt, or you can't start a business that you've always wanted to start because you're in debt. That should be a huge warning sign that the kind of debt that you're taking up is not sustainable, or the debt situation that you're in is not sustainable. And that should be your call to now start figuring out how you're going to be able to get out of that situation. There's also the scenario of relying on credit for essentials, whereby given that you're not able to budget your finances properly, you end up having to depend sometimes on credit to be able to pay out your daily expenses. So if, for example, going to the case of Janet, where we saw her income is 65,000 per month, but around 18,000 of that is going into debt repayments, purely on debt repayments. So by the time she wants to start spending, she's already starting from a much, much lower point. So she's not even able to sustain her lifestyle sustainably while still maintaining these debt repayments. So she ends up now taking up more debt to pay out her basic needs. So that's also a very huge warning sign that the kind of debt that you're getting is unsustainable. Then if you're also at a point where you're only making the minimum repayment, so if it's, let's say, your Mshwari loan is due, it's 2,800, you'll only pay that 2,800. You pay 2,800 just because that's the minimum amount that needs to be paid, but you'll take out another one, or you'll only pay the minimum amount on your credit card if you have a credit card, but still continue taking up more charges on that credit card. Things like that is now things that you should look out for because they are a huge warning sign that your debt is not sustainable. Then a huge debt to income ratio, whereby your debt payments exceed 35 to 40% of income. That's an insanely high debt to income ratio. And you can see Janet falls into that scenario whereby she's only surviving on less than 2/3 of her income because the majority of it is now going into repaying debts. And now this leads her into that vicious cycle where she'll keep having to borrow to sustain future expenses. And then using debt to pay debt. So here when you're borrowing to pay off a debt so that you can take out another debt for consumption, unless you're taking out a debt in the scenarios that we covered in the previous slide, whereby you have a clear plan as to you're using this debt to help you get out of a financial situation or help you get yourself in a better debt situation, that is fine. But if you're only using debt, if you're using debt to fuel more consumption or to buy assets that are depreciating or they're not going to build you, then that is a very huge warning flag that you're in a debt burden. So by looking at these factors, try check if you're in debt, try to look at yourself and see, have you seen any of these warning signs? And if you have, what are some decisions that you can start making to improve your situation? So I'm seeing in the chat someone has written, postponing life decisions doesn't look like a warning sign, but it is such a big warning sign. That's a very good point because it might look like I'm managing, I'm still able to pay off my debts, I'm still able to do this, but perhaps I've been wanting to go to school for the longest time, but I'm not able to save up for that. I've been wanting to start building my house. I'm not able to do that because all the money that I get is only spent on repaying debts and trying to sustain my daily expenses. Then I'm seeing spending every saving to save debt, remaining in nil every now and then. So you save up a bit, but you have to spend it to pay off debt. You spend it to pay to sustain your expenses. So you never end up building yourself. You stay in what we call that financial stagnation, as we saw happening to our case study, Janet. Then you're saying using debt to pay debt is survival technique. So whereby you're living on survival mode, we're trying now to get out from this survival mode where you're living on a paycheck to paycheck basis, hoping that I'll be able to pay this next debt, then I'll take another one and be able to pay that next one. So if any slight thing happens to me, I am not the fittest anymore. The way you say survival for the fittest, you've now been kicked out from being one of the fittest. So you end up now taking huge financial consequences. So you can see all these
I
warning
think,
signs.
Brian,
Yes.
I've just remembered something. When someone has
Yes.
a Fuliza limit of 10,000 and they only have 2,000, how much do they really have? Maybe that's not in survival for the fittest. I think it's good to hear from the people what they think. Your limit
Yes,
is
actually, that's a good
12,000, is
question.
10,000. Yeah, you have 10,000 in Fuliza limits, but your account is 2,000. You only have 2,000. How much money do you have? So you should,
12,000.
one boy says 12,000. Yes, if you don't have 12,000, what you have is 2,000. So it's good for us to always think about it that way. Thank you, Matthew, Brian.
Thank you. And that raises a very good point that, because, mentally, sometimes you might think that, okay, because I have a full of 10,000 and I have 2,000 in my M-Pesa. So I can, at least, if I need anything that's worth 12,000, I can access it. But yes, we have to remember that in as much as you can access it, doesn't mean you can afford it. Because what happens, you access that 12,000, and then now your income that you anticipated the next month doesn't come through. Or let's say you anticipated that someone was to pay you back some money they owed you. So you tell yourself, since I have 12,000 and Nani owes me 15K, I will just take this 12,000 and spend it because I know I'll even have a surplus of 3,000. Then this person doesn't pay you. Now you're left with Fuliza demanding 10,000 from you. The 2,000 that you had is gone. So it's a mindset that's very easy to fall into, but you have to be hyper aware and always call ourselves out on such things so that you don't end up getting into such situations. I'm seeing a comment here. Yes, Fuliza is not your money. They make daily money from you. Remember those daily charges that Fuliza charges? They're taking advantage of you because you are taking that mindset that, oh, this is money that I can access easily, so I should. Just because you can doesn't mean you should. If you have a good Fuliza limit, it is very good it is very good in case you have an emergency that you can't get yourself out of. We've said you should save up for emergencies, but in case you have an emergency that you can't get out for, you can use it at that point, but don't use it as part of your income that you're going to be spending. All right. So we'll move into the next slide where we'll see the ripple effects of having bad debt. How does bad debt keep now affecting our debt cycle, whereby affecting our debt patterns, whereby you find people getting themselves into a vicious debt cycle? So one of the things that bad debt might do to you, it might now bring around business challenges. So for example, we've seen that example of I take out a loan on Fuliza. That 10,000 I have, I take it out. I say, this weekend I needed to meet up with my friends for lunch. Let me go. Or there's this new shoe or this new item that I've seen that I need to buy. Let me spend on it. The money will come back. Then it just so happens that week you are short on stock and you need to restock and you don't have access to that money. You don't have access to any money. So you see that already affects your business operations, because if you didn't have that, if you had taken out that debt, you'd have been able to use that debt to do something more constructive. So it ends up affecting your business, whereby you're not able to restock on time, or you have to take very expensive stock. So even the kind of profits you make, it eats into your margins and now affects your business. There's also the health challenges. We've talked about the kind of stress that debt can give you and how it can affect your mental well-being. And your mental health also affects your physical health. So if I'm consistently worried about my debt and completely stressed out about my debt, I'm not even going to be in the best position to take care of myself properly physically. So that ends up even affecting my physical health. My physical health is affected. I end up now incurring medical bills, which leads me to further debt. So all these things can end up being, a small thing can end up being a huge ripple effect that affects you without you even knowing, and you end up getting into a huge financial situation, a huge financial crisis. Then there's also the loss of job and employment instability. So if you're that person who is always getting into bad debts, you have even Shylocks calling your employer to say you've not been paying us on time. It even now affects your reputation at work and affects your productivity. Even you being stressed out affects your productivity because you're worrying about how am I going to be able to pay out the next day. So you're not even able to bring yourself fully to work or in your business or in whichever venture you're working on. So given that you're not able to commit yourself fully, you end up not even underperforming, and now you might even end up losing your job, which affects now, which now even magnifies your debt situation. And then there's also the strained relationships because debt can also have a negative impact on personal connections. So if you're the kind of person who people will always be calling to demand their money back, who is always trying to call people before payday, trying to say, please sort me out, I'll sort you out before payday, or I'm expecting this deal from this client, and sort, please, I'll pay you back. So you even end up now straining your relationship because people just look at you as the kind of person who is always begging for money, who is always pushing people for money, or who is always being pushed to pay back money that they owe people, and it affects your personal connections and even some of your professional connections. So it strains your relationship, and it's something so small because we've seen how a small debt can easily grow. So even as that small debt can end up now leading you to being the kind of person that is in strained relationships with your friends, with your colleagues, with your family, because you didn't take the proper measures to manage your debt. And then we've also talked about the emotional challenge. This can lead into depression and mental health decline. We've had so many instances of people ending their lives because they got into bad debt situations, which led into depression, and they were unable to handle the situation, ended up having to take drastic measures. So it's very easy to fall into a debt trap. So we have to be very cognizant of these warning factors. Whenever you're seeing that perhaps I'm getting into a bad debt situation, I'm seeing the warning signs of a debt burden. So start fixing from where you are, and you can start from wherever you are. It doesn't matter whether you're 10 shillings in debt or 10 million in debt. There's always a starting point, and there's always a way that you can start from, a point where you can start from and build yourself so that you're in a better situation financially. So let's look at the impacts of poor versus good debt. And here we've mentioned that good debt is debt that you're using to build yourself, that is going to generate a return in the end, that is going to be able to pay itself back and even now leave you in a better position. But poor debt is debt that you're only taking to finance short-term consumption and does not build you in the end. It only ends up affecting your financial situation. So let's look at some of their impacts. We've looked at the overall impact of bad debt, but now let's look at the two side by side. So when you start with bad debt or what you call poor debt, you have the financial impact whereby it drains your cash flow because all this money is going to be coming out of your income every month or every payment period, leading to financial stress and potential default because you're always living paycheck to paycheck. You're unable to even, if anything small happens, you end up defaulting on your loans. So that's one of the hugest impacts that you see when it comes to poor debt. Good debt will help you build credit history because you're borrowing what you can manage to pay. You're making full payments, or you're making as much as you can make on the payments. You're making the payments on time. So even build a good credit score that can now even help you now take on more and more good debt. And at the end of the period, you're able to now build your financial position by utilizing debt. It also enhances your purchasing power. So let's say I have this business. I need to refill my stock. My stock is 7,000, but I only had the 2,000 in my M-Pesa. If I'm able to access, let's say from my SACCO or from my bank or from any other institution, I'm able to access a debt to finance my purchase of stock that can help me expand my stock. You see, that has enhanced my purchasing power and has supported my wealth accumulation because if whatever I'm getting out of the profits that I'm getting out are able to repay the debt comfortably, and I have some margins on top, you see, I'll keep building that, and that will continue supporting my wealth accumulation, as opposed to poor debt, which is now even eating into my wealth accumulation. Then for poor debt, you'll find that the rates are typically very high because most of these are taken by people who are high risk borrowers. They're people who can easily default. So these banks and these institutions and these lending institutions will of course want to price in their risk. They're here to make money. So they have to price in their risk. And when they price in their risk, you end up finding these very high interest rates that end up going into almost 3 digits on an annual basis. Then when you look at good debt, it's usually lower rates because first of all, the people that are typically able to access such facilities, they have a good credit score, they have a good repayment history, so their risk is much lower. They're able to be paid they're able to be charged a smaller interest amount that even now enables them to align their income with their to align it to their income growth. So I know that if I'm going to take up this kind of debt and I'm paying an 18% interest or a 20% interest, but the kind of margin I'm making is maybe 40%, maybe 50%. You see, that consistently helps me build myself, as opposed to even if I invested 50% debt in that 50% margin, I would be doing nothing. I'd just be netting out at the end of the month. Then we've talked about the credit score effect, because poor debt can damage your credit score if payments are missed or balances remain high. Because with poor debt, it's very easy for it to become a cycle, or for it to end up with you defaulting, which now ends up affecting your credit score. But if you're taking good debt, you already had planned for the kind of returns that you'll be able to get from your business, or even if the returns aren't automatic, you already had planned from your other income that I know I'll be able to pay out from this income comfortably, so that even when this starts picking up, it will now be able to repay. It will not be able to sustain me and my financial and my portfolio, my investment portfolio, in a good way. So good debt can improve credit score if managed well and repaid on time. Then the long-term outcome, you'll see that poor debt can easily trap borrowers in a cycle of debt and limiting their financial freedom. Because looking at a case study of what we've looked at, for example, looking at Janet. So if 18,000 of her income is going back to repayment debt, she's always going to be in that cycle of debt. There's never a point where she'll have a sustainable enough, she'll be able to put up enough of an emergency fund whereby she's able to not get into further debt, where she's able to now pay out her bills. Even if her salary delays or she gets into any medical emergency or any other emergency, she has some savings that she can tap into. So that's when she's in a better position, is just returning the savings, not having to start paying back debtors or start from a negative position. Then good debt enables asset building. We've talked about how it can help you now build a bigger credit score that gives you higher purchasing power, enables you to invest in bigger assets that generate bigger returns. It also enables education and entrepreneurship. Maybe you may be taking out a loan to pay out for school, because paying for that school will help you get a promotion or help you get a certain certification that will allow you to get a higher income. So that's also a good way of utilizing debt, because you're now able to build assets for yourself, you're able to build yourself, your education and your entrepreneurship capacity, building for financial stability in the long term. Then we've mentioned the emotional impact, whereby poor debt causes stress, anxiety, and reduced quality of life. But good debt is viewed as an investment with future goals, with a positive mindset, because you have a clear plan as to how these investments are going to generate you a return that is sustainable. So now we've looked at debt from what is good versus bad debt, how you warning signs of a debt burden. You've also seen how the impacts of both good debt versus bad debt, and also now the ripple effects of bad debt. So now I also would like us to just put in the chat box, similar to how we did when you were starting. So we've now gotten to see the kind of debt that you can carry, and I'm sure most of us have internalized. Most of us with debt, you've gotten to see where your debt falls into place. So now, if your debt could talk, what would it say? Would it be A, you used me to escape a hard season, but now it's time to face me? You were in a financial crisis, you needed that debt to get yourself out of it. But now it's time to face it and now start dealing with how to clear that debt and now build a healthy debt habit. Then is it B, I was a quick fix, now I'm a long-term burden? It was just a small scenario. Like, for example, that issue of the phone. You need to fix your phone, you just need 2,000, but you don't have that 2,000. You take out a loan, the loan is due before payday, you have to take another loan, and it ends up becoming a long-term burden. Or is it C, I grew because you weren't paying attention? So small things. I just take a Mshwari today, tomorrow I'll just top up kiasi. My limit is growing, I can access it. So you keep doing that until you end up in a bad situation. And then D, I wasn't the problem, the lack of a plan was. Perhaps this debt that you took was not a bad debt. It was actually a debt perhaps to finance your business. But because you didn't have a proper plan for that debt, you ended up investing it somewhere where you didn't plan to invest it. Let's say you went to get a loan from your bank to purchase some stock. Let's say you needed 100,000 of stock, but your bank tells you can access up to 500,000. You tell yourself, I can even expand my premises. But in your plan, the expansion of premises was not there. So you were just moving without a clear plan, and you end up now in debt that you can't comfortably sustain, and you're putting unnecessary pressure on yourself. So could you be in that situation? Or is it E? You're not alone. Many carry me silently, but facing me is your power. So maybe you've been feeling like perhaps I'm the only one around my peers who is carrying a lot of debt, but you didn't know that there's actually a number of people who are carrying debt. Perhaps you've seen in this chat people saying the situation they are in, and you're realizing, kumbe my situation is not as bad. You're realizing that perhaps your situation is manageable compared to someone else. So please feel free. Let me check in the chat and see some of the answers that are coming through. I am seeing someone say A, B, C, D, E. They agree with all, all the scenarios put out there. I'm seeing D, I wasn't the problem. The lack of a plan was. Seeing A, B, C, and E. Used to escape a hard season. It was also a quick fix. It wasn't paying attention and it ended up growing. But then you realize that you're actually not alone. There's many people carrying it silently, but facing is the power. I'm seeing B, D, quick fix, and now is a long-time burden. And there wasn't a problem. The lack of a plan was. And I'm seeing there's a lot of E's that are coming out, showing that a lot of us are coming to realize that, you're actually not alone when it comes to managing debt. We even saw from those statistics that we started with that around 53% of people reported that they're facing challenges with managing their debt. So it shows you that for 1 in every 2 people is worried about debt or is thinking about debt in one way or the other. So it shows us how that you're not alone in your situation, and that this should give you some reassurance that you can find a way to work it out. If all these people can find a way to work it out, and we can all work collectively, I'm sure each of us can find a way to support each other and be able to learn from each other and build healthy debt habits, get to learn how to properly manage our debts. I'm seeing someone saying, honestly, none of the above. They don't relate to any of that. Perhaps maybe they do not have any debt that they are carrying on board, or they have a very healthy relationship with debt, so they're not in that scenario. So yeah, thank you so much for putting on these comments in the chat. So that helps us see that you're not alone. Most of us are carrying these burdens. Perhaps it was to escape a hard season. Perhaps it was a quick fix. Perhaps it was a good debt, but there was no clear plan, and it ended up getting into a heavy debt situation. So now I'd like us to look at debt management and how we can utilize debt to build ourselves and to manage our debt in the best way possible.
And
So we have yes,
sorry for interrupting.
sure.
I'm thinking maybe we can give participants maybe like 10 minutes, a 10-minute
Sure.
health break, and then we can resume to cover why debt management matters.
Perfect. That's in order.
All right, great. Thank you. We will be back after 10 minutes.
And maybe until we can get questions on the chat as they take a health break as well.
Yes. And I also see on the Q&A tab, we have questions coming in. So let's address questions to the Q&A tab, and we'll have a Q&A session at the end. Thank you. Short break, and we'd like to continue with the rest of the training on debt management. Thank you so much for your engagement so far. Let's keep it going. Let's keep learning. Karibu sana Brian for part 2.
Thank you and welcome back to part 2. So in part 2, we are going to cover debt management and how some of the ways of managing debt and also the debt management cycle. And then we'll close out with looking at takeaways and what key things should we take out when you are getting to learn about our debt management. So we'll start getting to understand, first of all, before we get into debt management, why is it important to do proper debt management? So good debt management leads to, first of all, you get financial stress reduction. We've discussed how there's a lot of stress that comes about from holding bad debt. But when you have proper debt management, you're able to now manage that stress because you know when I'm going to pay this, I am sufficiently able to make that payment. If not, I know where I'm able to get a payment or how I'm able to restructure it in a way that works for me. But if I'm not managing my debt properly, I end up carrying increased stress and being stressed out over things that I could have properly been able to deal with. Then we've looked at good debt management and how if you're properly able to manage your debts, you're paying on time, you're able to now even access lower borrowing costs, as opposed to someone who does not manage their debt properly, who ends up getting considered a risky borrower. Therefore, they are charged exorbitant borrowing costs. Then you have financial control, whereby by proper debt management, you're in control of your finances. You're still able to pay into your emergency savings fund, whereby you're able to now manage your day-to-day expenses, but still able to make your debt repayments, as opposed to whereby if you're not properly managing your debt, you end up in a cycle where you have no control. You're only controlled by the deadline of the debt. If the debt comes due on this day, you have to now scramble to find money to pay it, as opposed to having the money already in place whereby you're able to pay it off comfortably. And then we've also seen the aspect of stability and growth, whereby if you're able to manage your debt properly and you have good debt in your books and you're sustainably paying off the debt, you're able to grow financially and also now build financial stability, as opposed to the financial stability that comes with bad debt, whereby if there's delay in payment or even you end up losing your job or your source of income, you're completely affected, as opposed to someone who has properly managed their debt, who already have a buffer in place. They have some savings that allow them to be able to make some payments toward that debt while still staying afloat. They probably even able to access a facility that enables them to consolidate and manage better or rework the payment terms. So if you manage your debt properly, in a nutshell, you're able to now sustain your financial stability and your financial growth, as opposed to someone who has poor debt management practice, who is now financially unstable and can be knocked out by the smallest inconvenience financially. So now, what does good debt management look like? So we'll look at what we call a good debt management, the effective debt management cycle. And it's a repeating cycle that it is set up of a number of steps that always repeat themselves. And by you repeating this cycle, you'll consistently stay in a good debt position. So we'll start by saying the thing that we say the most: borrow for value. You're borrowing debts that you want to build you, that are going to build value into you. You're not just borrowing for consumption or for something that will depreciate or for short-term conveniences. It should be something that is going to build you financially and help you scale to the next level when it comes to your finances. Then you should always know your debt cost, know how much debt you are carrying. What is the effective interest rate of this debt? Are there any hidden charges? Are there any penalties if I delay? Are there any penalties if I default? What are some of the hidden costs that I might not be seeing? So when you know that, you're even able to make the proper decision that is this debt worth taking, or should I seek out a more cheaper alternative? Then maintain your credit score. It's always very essential to ensure that you don't ruin your credit score. And how do you maintain your credit score? By making sure you always make payments on time, and you ensure that you make the payments in full. So if you're unable to make a full repayment, this should already have been communicated to your finance in advance, and you rework a payment plan, as opposed to waiting until the time when a payment is due and you don't make the full payment, which now affects your credit score, which is now going to lead you to borrowing at higher rates, leading you to finding yourself in that debt trap. Then use credit strategically. Credit should be used to build yourself or to improve your situation in a way that you're able to sustain it over a long-term period. So think about the kind of loans that you're taking. If it's a loan that's being used to build you, that's being used to put you in a better financial position, or to even help you start on your debt recovery situation, that's the strategic use of debt, as opposed to just taking debt to sustain short-term expenses or short-term requirements. Then another thing is to prioritize the debt. And by prioritizing here, we're focusing mostly on the debt repayments. You have to know which ones should you prioritize in paying. There's many debt repayment methods, and we'll touch on some of them in subsequent slides. But now, based on the best method that you choose, or the one that works best for you, you can now choose how to prioritize. So will I start with paying off this debt first? And once I pay that, which is the next one? And also, as I'm doing that, as I'm prioritizing the debt payments, am I also factoring in some of the other impacts that those other debts might be having if I delay in payment, or if I don't pay, as I'd initially been paying? So you have to consider all those factors. And one of the ways we can help you with that, as I mentioned, we have our prosperity tools, which have a dashboard manager, the debt manager, sorry. So the debt management tool allows you to now put in or list out all your debts, and now you can even see them now compared side by side with the kind of rates that you're paying on them, the repayment periods, so that helps put into perspective. So where am I currently? What are my total debts? And what are my total repayments looking like? And now which one can I now rework, and which one can I start with? Which one can allow me a bit more time to consolidate these others first? So that will help you now manage your debt effectively. Then always plan for repayment. As I said, always know when your debts are due and have a plan in place for the repayment. So you should take the repayment as something very sacred. Don't miss a repayment. So if let's say I was taking a loan to finance my business, I was buying some stock, but I've not sold the stock by the time a repayment is due. I should have a plan in place for how I'm able to get that money from somewhere to be able to repay that installment, so that I'm not ending up in a bad situation with my financier. Then we've also mentioned separate your savings from your debt. You have to remember that even as you're clearing your debt or as you're managing your debt, it is important to have the savings so that you don't end up now falling further into debt. Because if you don't have savings, you're putting yourself open to any single financial inconvenience will lead you further and further into debt and make your debt situation worse. So it's also very important to have savings. And savings doesn't have to necessarily be a huge amount. Just save whatever you can, because the more that you do it, the more that you build that momentum, you build that pattern of saving up, and you build that habit, and it becomes ingrained in you, and it becomes a given part of your financial habits that you have to put in those savings. And little by little, you building those savings is going to give you, first of all, a buffer from getting into further debt, but also now even allows you to now start tapping into opportunities, start tapping into investments that can even help you grow further. And then another important thing that many of us don't consider when it comes to looking at our debt situation is lifestyle creep. And it can happen very easily in the tiniest of ways, because as your income increases and also even as your access to debt increases, let's say you've been managing your debt very well, you always pay your debts on time, you always make full payments. So they keep increasing your credit. So at times you might be tempted to think that, oh, I'm able to even now since I'm able to access this much money, I can be able to do this and this, which is not part of your initial financial plan. Very small lifestyle creep. Let's say, for example, I could be able to, I need to buy a new phone, but now since I have access to this kind of facility, I can get the fanciest phone out there just because I have that, or just because I paid that debt, so I have a bit more disposable income. Majority of my income is not going to debt repayment. Perhaps I can afford to buy myself this and that, or start do this and that, or treat myself and do this and that. So that can slowly start creeping in to the point whereby, in as much as you had, let's say, this amount, let's say 10,000 of your income was going to debt repayment, and you've now gotten to a point where you've brought it down to 5,000, you end up now spending this 5,000 on other things, as opposed to now even diverting it to your savings, or now going into other debts and also clearing those as well. So it's very important, even as you're clearing up your debts and building a good and doing proper debt management, you also don't get trapped into the lifestyle creep that will now lead you you're not making any steps. You're just stagnant, because all the money that is coming through is being spent in consumption and lifestyle expansion. So we've looked at debt and debt management. So this one I just like us for us to internalize. Feel free to put in the chat, but you can also now just internalize by yourself. So reflecting on the financial and emotional impacts of poor debt versus good debt, what changes can you make in your borrowing habits to ensure your debt works for you or instead of against you? So now, based on what you've learned and some of the factors that we've touched on, what are some of the things that you think you can change in the way you're borrowing that can make debt work for you as opposed to working against you? So as you're going through that, feel free to type it in the chat box, some of the methods that you've learned. We'll touch on some of them and see how we can utilize them to build ourselves. So we'll look at some few debt management methods. I won't go much into details of it. I'll just give a slight overview of the same, but we are always very happy to engage with you and go further into it if you need any further assistance on getting to understand some of these debt management methods. So we'll start with two debt management methods. We have the snowball method and the avalanche method. I'm sure most of us have heard of these methods. So you know the snowball. When a snowball is rolling from the top of a mountain, it continues gathering more snow and becoming bigger and bigger and bigger up until the moment it reaches the base of the mountain. So how this happens, how you utilize this as a debt payment method is you start by listing your debts from the smallest to the largest balance. So let's say it's a Feliz of 200, an Mshwari of 1,000, Tala of 10,000. You list them in that order. And now you start with paying the smallest first. And how this helps you is by you paying the smallest, if you feel like, okay, I had 8 debts, now I have 7. I am starting from 7. I've 7 debts, now I have 6, and it keeps building like that. And you're paying on bigger and bigger debts. So it keeps building that momentum and encouraging you. It motivates you through those quick wins. And this mostly works for people who are looking for visible progress to help them stay motivated. At least they're seeing there's a change. I had a Tala and Mshwari, now I just have Mshwari. Or I had 4 loans, now I just have 2. That now gives them that motivation. On the opposite end, the avalanche starts big and now goes sweeping everything in its way up until by the time it gets to the foot of the mountain, it's lost majority of its power. And how this happens is now whereby you start with the highest interest debts. So you list out all your debts and start with the one that bear the highest interest. You'll find that most of them are these mobile loans, Shylock loans, and the like, because they're charging you a higher interest because they're more risky lenders. So by doing that, you start listing those out, and then you start paying. You start paying out you're basically trying to minimize the interest paid. So you're doing that by paying the highest interest debt first. So if it's those mobile loans that are incurring you 50% per annum rates, you pay those first, so that now you're left with, let's say, your bank loan that's giving you an 18% rate, or even your circle loan that's giving you a 13 or 14% rate. So you start by breaking those bigger ones, because now, first of all, it reduces the kind of interest burden that you're paying, because you're now paying smaller interest because the loans that you're left with are bearing a smaller interest. So it's usually very good for people who are disciplined and patient, and those who have a lot of high interest debts, because now they're able to clear those and they're left managing more manageable debts. Then the other debt management method that we have is a lump sum repayment. So here is where, let's say you get a lump sum, either you get a bonus at work or you get a windfall from a client or anything like that. You get a huge tax, you get a huge amount that you can now use to pay out your full lump sum. This one typically happens. It's very rare for this to happen, because majority of the people who are facing a lot of debts cannot access that lump sum unless they consolidate it from somewhere, whereby they get someone to help them pay off those debts. So this typically would work for someone who receives irregular or unexpected funds and can commit to directing these windfalls towards debt reduction. It could even be something like, let's say, if I'm a salesperson, for example, I have my retainer and I have my commissions. So I can tell myself I'll survive on my retainer, and then any commissions that come through can go towards dealing with my debt. So that can be considered also a lump sum repayment, where you're able to direct irregular or unexpected funds towards your debt reduction. Then you have debt restructuring, which talked about this, whereby you talk with your lender to modify terms, such as either lowering your interest rate or extending your repayment methods or allowing some breaks. So perhaps you're going through a financial challenge and you're not able to pay over the next 2 or 3 months. You can discuss with your financier to get that put in place, so that as opposed to you defaulting those 2 or 3 months, you have a debt payment plan in place whereby you're able to now recover without having to ruin your credit score. So this one typically happens to borrowers who are experiencing temporary financial challenges, and they need adjusted repayment terms so that they stay current with their payments. So you saw a lot of this happening during the COVID pandemic, where some people had cuts to their income. So they ended up restructuring with their financiers so that they're able to still manage to make the payments without having to default on those payments. And then we've talked about debt consolidation, whereby you combine multiple debts into a single loan at a lower rate, and you also now simplify the payments. As opposed to paying 4 different lenders in a month, you're only dealing with one lender, and you've planned it properly, whereby the repayment period is coming comfortably after you've been paid, or after you expected income from your clients, or whichever other income source that you have. You've planned it out properly, and you have a backup in case that plan A does not work out. You still have a place where you can tap into either your savings or any other place to be able to now pay off the installment. So consolidation typically works with people who have many debts that they're trying to now get into a more manageable plan. And then you can also now refinance, whereby someone you get a loan done by another, bought out by another lender or another financier, which will now give you new terms, either lower interest rate or a longer repayment period or more structured payment period, that now reduce your monthly payment budget or your frequent payment budget. So typically this will work for borrowers who are facing high rates, who can benefit from improved credit or lower market rates. So there's many other methods. Those are the key methods that you typically look at when you're considering managing debt for yourself as an individual or even as an entrepreneur when you're building your business. So we'll conclude by looking at the path to financial freedom, the sort of a journey that you can walk through if you're trying to now get from a point of poor debt management to good debt management, to be able to even now utilize debts to build for the long term. So the first thing that you should do is, if possible, stop the leak, pause all new borrowing, avoid adding any more due debts, start with what you have currently, then you know, break out a plan of how you're going to attack the ones that you have. Then list out all those debts clearly. When you were starting, Elizabeth said something very important. You have to know where you are so that you know where you're going. So you have to know all these debts that you have, every single debt, list them out. Be it a mortgage, be it a car loan, be it your Fuliza, be it your Pshwari, all those loans, be it a facility from your bank, you list them out very clearly, including now the interest rate and the frequency of repayment and the repayment amount, so that you're able to have a clear plan of all that you owe. Then now that you've looked at your debt, you also now have to look at your other financial aspects. Now, your income and your expenses. How much are you expending on typical expenses? Is there a way perhaps you can cut that down, or you can reduce that? Or your income, is your income consistent? Is it sustainable to be able to pay that debt? Or should you now start looking for other sources of income, or trying to expand your sources of income, or ways in which you can generate more income to pay off this loan? So once you've done that, you now then choose a repayment strategy. How are you going to repay all these loans? You've listed the amount. Does it make sense for you to start paying them using the avalanche method, or to use the snowball method? Or does it help for you to consolidate the method, to consolidate your debt and now just deal with one lender? So you choose a repayment strategy. And then now you negotiate with your lenders. You communicate this payment plan to them that, okay, this one I'm going to be paying this much minimum payments per month. I want to change my payments to bi-weekly or something like that. You now agree on a payment plan, and perhaps how it's going to be deducted. Is it going to be coming directly from your salary? Are you going to be making payments on a specific date? So you have to get that clear in place, and you document that. And then it's also very important to create an emergency buffer. Even as you're paying off these debts, remember to build a savings buffer to avoid you going further into debt. Remember, at our starting point, we said you have to stop that leak and pause all new borrowing. So to avoid doing that, the only way you can avoid that is by having an emergency buffer, so that whenever you're in an emergency, you won't have to dig into your to have to take out more debt. You can just dig into your savings, and you'll be able to easily repay back when you're in a better situation. Then also get accountability and emotional support. We've spoken a lot about the impact of debt on our emotions. And it's very important to now ensure that you get emotional support and accountability, so that you're able to manage that. Because it's very easy to commit to a plan, but sticking to that plan is very hard, because I might say I'm going to be making 5,000 payments every month, or let's say 1,000 every week. But there's one week where money is tight, I'm not able to make that repayment. And since no one is going to ask me anyway, I'll just keep that payment. But if I had an accountability partner, or I had someone supporting me and checking on me, or consistently reminding me of my financial plan, that will help me stay accountable. And your accountability partner can be your friend, can be your spouse, can be your colleague. You can also now get a professional who is now going to help you stay accountable and support you. You can also join a coaching group that can support you at the same. Then also now focus on income growth. In as much as you are attacking the debt, you also now need to focus on how you're going to be able to grow your income more, so that you now even increase that buffer. You're able to now save more, and even now to able to pay a huger chunk of your debts and your other expenses. So explore quick income streams that can now build you based on your situation. Everyone's situation is different. Perhaps not everyone can start a business, but perhaps you can offer a service that can get you some money. Perhaps you can be able to tutor someone, you can be able to coach someone, you can be able to do something within your field. You can be able to you can be able to produce a product for someone, and they get you and it gets you some additional income. So look at your abilities and your capabilities, and see where you're able to build additional income streams. And then it's also very important to track your progress. It can be weekly, it can be monthly, based on your own financial plan and how best you think it works for you and your income payment periods and things like that. You have to consider that. So now you always track the progress and see, okay, last month I had anticipated to pay off, let's say 6,000 worth of my debts, but I've paid 6,500. What does that imply for my others? Does it mean perhaps I'm able to make 6,500 of payments every month, or maybe even take it up to 7,000? Or maybe last month I said I'll pay 6,000, but I'm only able to pay 2,000. Perhaps I was too ambitious. Is there something I can do? Or is there something I can rework that can enable me now meet that, to meet my initial targets? And then at the end of that, rebuild for the long term. So start long-term financial habits. Even as you're managing your debt, remember to now also consider now other long-term habits, such as saving for your retirement, saving for the short for your future, saving for other assets that can help you grow and build your financial capacity. So always remember to, even as you're doing all this, you always have to have that long-term plan in mind so that you avoid being constant, or you avoid being stuck in one place stagnant. So by following these steps, you're able to now consistently now work yourself out of a poor debt management situation and now get into a place where you're able to sustainably manage your debt. You're able to utilize your debt to build you as opposed to affecting your financial situation. So debt freedom isn't about luck. It's about discipline, decisions, and a clear plan. And once you get to debt freedom, what will that look like? So we've talked about stress. You'll have less stress and you'll have more options because now you even have some savings in place, or you have access to credit that can allow you to tap into more opportunities. You have more disposable income, since majority of your income isn't just going to sustain debt on a debt cycle basis. You're able to sustainably to pay out the debt while still managing to invest in other assets and build your financial future. And also a better credit score, which now gives you an improved financial reputation and access to more loan opportunities that you can utilize for good debt to build yourself. So I'll conclude by giving us a clear plan of what you can do. What are the next steps now from here? So we've said you start first by listing your debts from smallest to largest regardless. Then classify the debts by the amounts and interest rate. Which ones are payable monthly, which ones are payable quarterly, which ones have a higher interest rate, which ones have a lower interest rate. Then make minimum payments on all your debts. So do not skip any debts. If as opposed to skipping a debt, you'd rather consolidate it or discuss it with your financiers so that you can refinance it or you can restructure it to avoid defaulting and affecting your credit score. Then any extra amount that is left, pay the small debt first to get rid of them, and then pay as much as possible on your smallest debt. If whichever smallest debt that you have, if it's a full loan, start with that, because that's going to build momentum and give you that discipline to start paying off your debts and building that habit of paying off debts. And then you repeat that cycle until each debt is paid in full. So in a nutshell, we have seen that debt management is not a complex process. It's going to look very different for different people because we are each at different stages in our finances, and we each have different financial capabilities. But as long as you understand a plan that works for you, and you get to understand what is good debt, what is bad debt, which are the best sources of debt to get, and why, what kind of debt should you avoid, and how do you consistently manage debt properly without getting into a debt burden. Once you factor that into place and you follow those steps, you're able to consistently manage your debt and build a better financial future for yourself. So at this point, I will hand over to Elizabeth. She'll help take us through, tackle some of the questions that we are receiving, and get some feedback from the rest of the team. So thank you very much.
So thank you so much, Brian. I think the answer is in the doing. So yes, I'm sure most of us have heard what you already know, but the question is, what is the next step? Because that is where you look back 3 months down the line and say, for sure, this changed my life. So I know we were here in May. I'm sure some of us opened investment accounts and we started. So today, I want to start at where Brian has said. What is the work? And then maybe just from by show of hands on the chat, how many of us know how much they truly owe? Or have an idea where to go get how much they truly owe? Even if you don't have the exact number, at least you know where to get that. I just want to see that in the chat. Thank you, Ben. Thank you, David. I like the interest has not accrued for Ben. So I know how much I owe. How many of us have an idea, might not have an idea of the total amount they owe? Yes, thank you, Colin. Great presentation, Brian. Me, I know. Okay, great. I think the beauty is at least we know where we are starting. How many of us have a worksheet where we have all those loans somewhere? Or is it that how do we keep tabs with what we owe? In a spreadsheet. Thank you, Raymond. Because remember, at the end of the day, when it comes to personal finance, you must document it. In as much as we do a lot of finances for our businesses and for where we work, we must document it. So that's what the assignment that Brian is giving us. Let us have it somewhere in our worksheet. I keep a diary. I try to keep. I have worksheets. Good. This is really, really good. So I would like us to go to the questions because we have a few minutes to go. I don't know how, Machi, I don't know how we handle the questions. I have answered most of them as we were progressing. So I don't know whether you could guide us in terms of how we do this. And there are a couple of people who are raising their hands. I think, Machi, you'll guide us?
Yeah. Thanks, Elizabeth, and thanks, Brian, for a great session. I think we can begin with those who've raised their hands. So I'll allow a few of them to talk, so you can unmute. Maybe we begin with Shamina, and then Shireen, Eunice, Charles. Yeah. All right, let's go. Eunice, I can see you've been able to unmute.
Hello, good afternoon. So I have a question on taking loans. What would you advise someone like me who I took a loan for the business, but then the business, it does not give back the amount of money which I thought it will give back for me to be able to repay back the loan, because I was supposed to be paying it on a monthly basis, but the business, it's not going the way I thought it will go. So the interest for the loan, it keeps on growing every month, and I don't know how to get out of that debt, because I took the loan specifically to boost the business and for the business purposes.
I think, Machi, we take a couple of them, all of them that are raised, and that's why we answer all of them for the sake of time.
All right. Okay. Thanks. Thanks, Eunice. Shamina. Esther, Charles. Can go ahead, whoever is able to speak. All right. Okay, I've seen Charles has dropped his hand. Esther, Shamina. Okay, I think we can handle Eunice's question, even as we wait for Shamina and Esther.
So, Brad, I don't know whether I try answer on your behalf, but if, for example, you took a business loan and the business itself is not sustaining, you need to think about how do you cut your losses. Is the business, are you taking, because now the problem, it seems like you're getting money from somewhere else to put into the business. So I think you need to go back to the business fundamentals, do the financials again to see if it's something that you're going to be able to continue. Otherwise, it's you can actually think that how do you cut your losses? Do you reduce at the business itself, pivot the business so that the cash flows are coming? Might make sense to have a discussion with a business coach even as you think about the debt, because you see the debt will remain. Whether you must have taken it in the form of in your own name, so that one will not go away. So what you must do is figure out how to turn around the business so that you're able to pay for it. Or alternatively, do you sell the asset that you used to buy the business and then cut on those losses? So it's an issue of having a business coach go through the conversation so that you are able to know exactly why is the business not working, and then how do you turn that around. So hope that answers you, Eunice.
Yes, thank you.
Great. I can see Helen Valentine. Yes, Helen, you can go ahead.
Hi. I just wanted to request you, could you go back 2 screens, the screen that showed the sneaking down of how to handle the debt? That's great. Thank you. That's it. That's all I need.
And we shall share the presentation, if I'm not wrong, Mantuia.
Yes, we shall. Okay, so Valentine, Esther, Shemina. All right, if they're not able to, okay, we can now go to the charts. Let's see, I know Elizabeth, you've answered quite a bit. But let's see. Okay, I can begin with Samuel's. Is it advisable to stay loan free? That is, clear all the loans that I have.
So the answer is depends with which school of thought. There are two key schools of thought. I think there's one that says use other people money to grow money. In a country like ours, where interest rates can be 10, then they go to 20. I think from experience, it is better to in such a country where interest rates are very volatile, it is better to reduce your reliance on loans because they can really throw you off. But if you do a business plan and then you see that the return on that business of the investment plus the cash flow are able to pay the loan, then you can't take a loan. But the thing is, just be aware of do your sensitivity analysis so that if things don't go they're supposed to go, how else do you get out of that conversation or of that loan? So the answer is you should not stay out of loan, but be very careful, especially in a country like this, where interest rates can change quite significantly. So your returns from an investment should be significantly higher. Thank you.
Thank you, Elizabeth. Victor, you can try and speak. Yeah. Can see your hand is up. Okay, as Victor sorts out the sound, Kevin asks, what advice can you give to someone who earns less than the monthly spendings? And then also touching on credit card, is there any benefit to keeping it? This is from Ebony. And if I pay it off and close it, will it harm my credit?
Okay. So if you're earning less, if you're spending more than you're earning, there are two things. So first of all, the reason why you do a budget is so that you can create discipline. So you can start by looking at your budget and seeing what you can cut, but that will not get you out of financial problems. Ask yourself, how can you earn more? So look at the various ways in which you can monetize your hobbies. Think about things that you can grow, maybe even if it's your salary. How do you make sure that you get the promotions? So you're delivering and being seen for what you're doing. So you must be very intentional about increasing your revenue in as much as possible. So yes, budgeting is one thing, but it will never get you out of financial problems. That will help you with the discipline, but you must look for an alternative way to increase your income. In terms of credit cards, definitely credit cards come in handy, especially if you're traveling, you're paying some things online. So those they come in handy. But the question is, please do not misuse it. Just make sure that you're paying it on time because credit cards are very expensive. I think on average it will be between 3 to 5%. So on a per month basis. So that they end up being significantly expensive. So use them when you must and pay them on time. That will help you increase your credit score.
Great. And
I think
Elizabeth,
I've answered.
yes, and you've touched on the credit score. June asks, he's keen to understand, or she's keen to understand how the credit score works and how to build it.
So the credit score, well, how it works is just people want to see how you are with credit, how positive you are or negative. So are you able to pay your credits on time? And remember, this is a factor of cash flow. So they will look at the cash flow that you're having, then they look at how the debts that you're having and how you're repaying. So you need to work on both, increase your income, but at the same time, when you take a loan, make sure that at least you are repaying them on time. So the biggest problem with credit score is actually taking loans and not paying. What is considered as a good credit score in Kenya? I think it's really, as long as you're not, I think in this country, one of the biggest issues, one of the things that we look at is ability to pay. So as long as you're not listed in CRB, then you have a good credit score. But now the challenge is when you go to DTB, they will look at the ability to pay. So they'll give you a loan based on your ability to pay, even if you are not listed. So whether you can access 10 million or 5 million, it depends on your cash flow on the business or your cash flow as an individual or the business.
Great. We have an anonymous attendee asking, is it advisable to borrow to cover insurance premiums? Let's say you had taken an educational cover and you lose your job in uncertainty. And then, yeah, so that has come twice. Yeah, I think we can answer that one.
I think the thing is, you look at return. You need to look at the stage at which the cover is. If, for example, the returns or what you're going to lose is much more than the cost of the cost of the borrowing, then you can take it. So it's a case by case. If, for example, you have just started and then you lose your job, and maybe what is at stake is less, then you can choose to let it go. So most of these things are the reason why it's personal finance, it is very specific to an individual and a specific circumstance. So there are times that it will make sense, there are times that it might not make sense. So if you're about to mature and you're going to lose that money, so it's better to take and pay.
Great, thank you, Elizabeth. Victor, I'll maybe give you another opportunity. I've seen your hand is up. Okay, great. I think they put down their hand. Right, so yeah, I think what is mostly left in the questions is more like comments. We have someone asking about how a budget worksheet looks like. And then Emmanuel asks who legally has access to an individual's credit score. And yeah, I think we can answer those ones and then we will wind up after that.
I think who can access your credit score, it has to be when you're applying for a loan and you're given the loan, you have to give the banks the consent to get your credit score. They're the ones who can get your credit score, or yourself. Legally, those are the people who can get it. You have to, because it's a personal score, you have to give consent. The other one was what?
A template, I know
We'll get
Spirit
someone
has, maybe you can touch on what a budget template ideally should have.
Oh, okay, so what's ideally, a budget should reflect your lifestyle. So you need to look at what are the incomes that you have, and some of the questions that you also need to ask as you're doing that, what are the other potential incomes that you can actually be able to have? And then now you have to list all your expenses and you have to bucket them by discretionary ones, the ones that are a must do. But one of the key items that we always omit is the most important one, which is the savings or debt payment. And that should be automated so that it goes out of path. So what can you do? You can actually go to our website. If you go to our website, you'll be able to access a budgeting app that will help you come up with your budget, help you actually document all your loans as well, so that you can be able to start saying, this is how I'm going to knock them off. So just go to our website and you'll see prosperity tools, and you'll be able to see all those things there, including the calculators for the loan.
Great, thanks, Elizabeth. I think I'll take one more question, and this one is from Wycliffe, who says, I took a loan and bought a 1-acre shamba back in Ushago from our job circle. I paid nearly in full and agreed to pay the balance within a year. Time went really fast and I had to do a top-up to clear the balance, but now it has put me in a financial crisis because I earn less than my expenditure. Hence, I must take soft loans from my friends and mobile loans app. I haven't defaulted on my circle loan because it's directly deducted from checkoff system. My question is, how can I get out of this situation? Because I don't have even cash to do farming in the shamba to bring me some income. I've tried leasing, but the rates are very low and it can't make a difference. Yeah, so thank you, Vicky, for sharing. So Elizabeth, you can help with that.
So I look at this in terms of what do you want to eventually do with that piece of land? If it's something that you must do, then you must look for a way to increase your income. Because that is not question. If you must keep the land, then the income. What are the ways that in which you can increase your income? That's one. If you cannot, can you also consider selling off? Because at times we have to make hard decisions to keep ourselves sane. So one of the challenges is keeping on a wrong path because you already took it. So you must be look at the person in the mirror and tell them what is the right thing for them to do. If you can get someone to buy the land, I would sell it. If I was in your shoes, I would sell it if there's a buyer, because eventually you will have much pressure. And if you look at what you're saying, your mobile loans application, you will be lucky if your mobile loan application, the loans are not at 8 to 10%. Let's just take an example of a loan that is at 10% per month. That is 120 at least 120 per year. You cannot get an investment that will give you 120%. It is impossible. So your appreciation of the land cannot be more than that. I hope that helps you think through.
Thank you, Elizabeth. Those are really good, thought-provoking questions. So, ladies and gentlemen, because of time, allow us to close on the Q&A session. Thank you so much for your participation. I'll allow Brian and Elizabeth to give their closing remarks on debt management, even as we conclude on session 1.
I think my only one comment is you have to take action. So it's one thing that the bank is allowing us to come learn from each other, but the key thing, or what will make a difference 2-3 months from today, it is the actions and the decisions that you make today. So my recommendation is, please, let's start by just documenting what we have. Let's understand, let's take stock of how we got here, and then let's come up with a very clear way of getting out of here. Again, my recommendation is, if you can actually be able to look at your financial well-being by just going to the prosperity dashboard. That will help you just provoke you that you will be able to understand how you go to the next level. Thank you so much, Mantui. I think, Brian, you can go.
All right. Thank you, Mantui. Thank you, Elizabeth. So mine is also to just echo what Elizabeth has said. Always just keep it documented. Document what you owe and all your debts. List them out. And also, it's also very important to have someone that's keeping you accountable. By having someone who is consistently reminding you, what is your repayment plan like? What is your debt management plan looking like? At least that's someone who is going to keep you accountable and keep you on track. And also, please feel free to use the tools that we have. For example, the prosperity dashboard, that's going to be very useful in helping you assess your debts and helping you now plan better. But also, I'd just like to close with saying, remember that everyone's debt management plan looks different. So pick what works best for you, as opposed to what is considered an ideal. Pick one that you know is going to work for you, because your financial situation is going to be very unique to you. But thank you very much. Thank you for being such a participatory group. I truly appreciate it. Thank you.
Thank you, Brian. Thank you, Elizabeth. And for the participants, please remember that you can always access previous trainings if you go to the DTB website, whether it's on personal financial literacy, and also those who are running businesses, you can get resources that can help you. So even when Elizabeth refers to the budgeting, there was a session that they did earlier on in the year, so you can always refer back. And we will also share the slides from this session as well as the recording. So you can always go back, refresh your memory, and just keep up to date and on track with your journey. So once again, thank you so much. Please take time after this session to fill in the survey that will pop up. We always want to know, is the training relevant, what you are keen on learning, and how we can improve. So we request that you take your time to give feedback, and we will be seeing you next week, same time, same place, and module 2, introduction to investments and fixed income investments. So it would be great if you can refer first of all back to the modules on investment that we touched on in May, so that when you come in, as we delve deeper, you're not starting from scratch. So thank you so much, Brian and Elizabeth, Lillian and Victor as well for sign language interpretation, and most importantly to all of you for joining in and engaging. We hope this continues to add value to your personal finance journey. Thank you and have a good day.